Welcome. We are so glad you're here today. I'm really excited to share with you about our newest opportunity, Sage Meadow. My name is Rebecca Taylor. I am the founder of Tailored Investments, and I am here with my partner and friend, DJ Tosh. He is from Arrows Capital Group, and I will give him a minute to introduce himself here soon. I'm just briefly going to introduce Tailored Investments if you are not familiar with us, if this is your first time hearing from me. You might have seen some of my emails or we've connected through events. I am a third generation real estate professional. I spent 10 years in the tech world doing sales and marketing while doing real estate on the side. My husband and I bought our first rental back in 2012, and in 2020 decided it was time for me to dive into real estate full time. And so I got my license as a realtor, purchased more rental properties, and then stumbled into the passive investing world and was blown away by some of the benefits of passively investing in real estate. You're still able to take advantage of cash flow, appreciation, equity growth, tax benefits, diversification, and it's very hands off. So you don't have to deal with toilets and tenants and trash. And so as I got into this world, I spent a couple of years at two different firms, and then we started Tailored Investments to help others passively invest in deals. And so we identify, analyze, and acquire income producing assets so that we are able to help others live life more, work less, by having some of that passive income help supplement their life and spend more time with the people they love. And so I'm very excited about this opportunity. We did a deal with Arrows Capital Group last year, Serenity Villa in Wisconsin, and it has just been going phenomenal. My parents actually invested in that deal, and I got a text from my mom the other day, and she was like, "I'm so glad you told us about this opportunity. It's been so great." And so I'm pumped to share, and I'll let DJ share a little bit of background on himself and Arrows Capital Group, and then we'll dive into our presentation today.
Hey, everybody. Thanks for taking the time to check out this opportunity that we have currently. This is the Sage Meadow deal that Rebecca is alluding to. So we're excited to dive into that. I'll rewind to 2021. Both Lauren and I founded Arrows Capital Group, and initially we were thinking about leveraging our shared experience in real estate investing to build a team and a company that was genuinely and truly focused on a value set and not just on the execution. So we began to believe together that both these things are not mutually exclusive, but running in parallel like a set of railroad tracks, things work better. And so as we began to build a team and we began to focus on values, we really prioritized how we did that and took that focus to multifamily. So Arrows Capital Group started in 2021, and we dove right into the multifamily space because that was a continuation of some of the work that he and I had already been doing. And, built our way up to several hundred units in the multifamily world. But that time in that world was very competitive, and it'd be an understatement to say things were very frothy. So we, in that time and space, continued to learn, continued to iterate, continued to grow, and look for other opportunity. We both really felt like there was a lot of fish swimming in the river, and they were all swimming in the same direction, and we were one of those fish. And so we explored other asset classes and eventually made our way to assisted living, which is, it's not a new asset class, but there's a couple things about assisted living that are maybe more difficult to wrap your head around, in that you can't just dive in. You could dive in passively, which is what we're proposing here, but operationally, you really can't just dive in. There's a real barrier to entry in assisted living. You can own the asset, but we felt like and found out pretty quickly that there's a real risk to the investor class if you own that asset and that asset is being managed or operated by somebody else whose incentive structure is not truly aligned with yours. So the barrier to entry was real as we came to the space. And then, the complexity of the investment itself was a real thing that I think from the operator's chair, it gives a lot of operators pause. You can buy a multifamily asset, you can throw paint on the wall, and you can put luxury vinyl plank in there, and you can raise rents, and you can drive revenue, and you can do those things. And it's much more non-invasive. It's much more hands-off operationally, because your 28-year-old tenant is coming in there just to have a place to lay their head down. And initially, a lot of our language revolved around taking care of those tenants, those residents, and truly valuing them alongside of the paint and the luxury vinyl plank. We saw a lot of that in that time, where that was kind of like the rally cry, which is great for driving revenue and great for you as investors. But we felt like there was a layer missing, which was, how do you actually take care of and value your residents as you grow a portfolio, and not just have it be platitudes and words. So that's kind of what attracted our team at the beginning. And as we moved towards senior care, we just felt like our words really started to align more and more. These are folks that are in the winter of their life. They're in a season where they're looking at the end, whatever that means for them. And there's a lot of ways that value-oriented language shows up at that point, at that crossroad. There's a lot of ways that we've come to learn that we can help people in that part of their journey while we own the real estate and while we operate the businesses. So, this has been something that as we explored, and as we committed, and as we've continued to learn, we've really been the beneficiaries of learning more about ourselves, and then connecting those learnings to you as the investor, so that you can feel like not only are you investing in something that is genuinely going to create a return for you that we benchmark, but also that you're taking care of people in the process. This investment is a vehicle that does that as well. And we very much care about that side of the equation, because it's actually a very virtuous thing when you can get the resident base, the community behind you, and your employees behind you, in order to drive the success of the investment. And even, in our future version of the world, where we're outperforming what we say we will. So that's kind of a very quick journey through the evolution of looking into multifamily, being very combative in the multifamily space, and then trying to find a more nuanced version of real estate, and then even maybe a more nuanced place, which we could talk about as well. We didn't go for a Sunbelt market, right? So we'll take this opportunity in stride to talk more about the specific investment and whatever else Rebecca wants to highlight throughout this webinar. But that's a little about us. We're not young in real estate. We're a little bit younger as an investment firm, but we're pretty excited about connecting values to investments and providing returns for you.
That's great. Thank you for sharing that. And that's one of the things that really attracted me to Eros Capital Group when I started working with them last year. They were introduced to me through my business coach, actually, who works with them as well. And I was just blown away by the way that they do business. They truly live out their integrity and their ethics, and they do right by their residents. And I just love the fact that we're getting to have impact in people's lives, especially in these later years. They've gone through a lot in their lives. And so to be able to be in a safe, comfortable, enjoyable living environment with friends and community, I think that's huge. And so that's part of what gets me really excited about this deal and about working with this group. They do such a good job. My family and I were actually at Serenity a couple months ago in Wisconsin, and we had the chance to walk through a number of the buildings and meet some of the staff. And it was just so clear that people were happy to live there. It didn't smell bad when you walked in. I mean, it was just very cozy, comfortable. There's a lot of great outdoor living space. There was even a salon where people could get their hair done. I mean, how beautiful is that you can just go down the hall and get your hair done, and just be in that community. So I'm very, like I said, excited. I've said it a couple of times, excited about this deal. We're going to actually pull up a slide deck. I'm going to show that to you real quick. See if I can figure this out. I am a little bit technologically not savvy. So let's see if I can, where did it go? DJ, I had it pulled up just a second ago and now it's gone. What are you seeing?
I just see us.
You see us. Oh my gosh, of course. Oh, No, it's gone. That's top one. I might have to see if I can edit this part out of our. Let me see the rest of the screen.
The deck went rogue. It ran off into the
went-
wild.
Oh, it did. Portion of the screen slides as background. Let's see. Do you see? I'm just going to have to try to edit this out here. It truly is gone. It's like, oh, there we go. Whew, I found it. Do you see it?
Yes.
All right.
Hey, that
Sorry,
just makes this more real.
that's right.
Totally
Thanks for your
fine.
patience, everyone. I appreciate it. All right. So let's dive in. This location, there's actually two buildings, and it is in Fond du Lac. Am I saying that right?
Fond du Lac, yep.
On a lot and De Pere in Wisconsin. And it's a great market. We're going to dive over to the projected investor returns. These are solid. I've been really, really impressed so far from what has happened with Serenity. That property started distributing about a quarter after closing, and we should hit 8% in the first year, which I'm seeing a lot of deals come across my desk, and I'm a part of some other deals as an LP and as a GP. And it's tough to hit that kind of cash flow, especially early on. So, I mean, you can see here the average cash on cash return is between 10 and 14%. It's not going to start at that right away, right, DJ? It'll probably be a little bit lower than that in the first year. But the multiple is 2.1 to 2.7. So basically, if you put 100,000 in, the projection, which let me be so clear, this is a projection, it's not guaranteed. The projection is that you'll get back your initial principal investment, say 100,000 plus 100 to 170,000 in profit at the end. This is a 5-year hold. And so again, projections, please note, it's not guaranteed, but this is based on some very conservative underwriting, and the IRR is really solid as well, between 17 and 24%. Again, dependent on when we sell the asset, and the minimum investment amount on this is 100,000. So that's a look at the returns. We go over in this pitch deck the primary asset class risk, which I might give you just a minute to hit on those. We don't need to deep dive into this because I think people can check out the slide deck. But do you mind sharing a little bit about the risk? Because that's one of the questions I get a lot when it comes to assisted living.
Yeah. Kind of alluding to what I talked about already as we dove in, the preconceived notion is that there's a ton of risk. Well, it's actually legitimate and real. And the way that we've kind of thought about this is the principal risk in my eyes is the fact that this is a very human intensive business to operate. So as you look at the real estate, doing what real estate does, which is sit there and do nothing besides house our residents. When you look at the business is alive. The business is the people. And in this business, we have a lot of care workers that take care of our staff. So you have a risk at the business level. And this is why almost immediately we went from being just asset managers to business operators. And now have even kind of taken that further, and some of that stuff we could talk about as we go here, but staffing shortages are a huge concern if you're into really anything anywhere at this moment in time. Staffing, the labor market is a concern across the small business spectrum. So that's something that we have really tried to take, again, our origination, our value set, our desires, and bring those over to the operating business here at what will be Sage Meadow, and create a culture within the business that minimizes the risk as it pertains to our employees and their desire to go someplace else for employment. And you really genuinely have to work at that, creating that environment and empowering the leadership to be able to then empower the caregivers and come alongside them to teach, to train, to love on them when they need to be loved on. And if you don't do that, then you experience a lot of what other people have experienced in this asset class, where it's actually the business that causes the real estate to fail. So, that's the one that we look at a lot. Regulatory stuff, Rebecca and I were chatting before this. I think we have regulatory tailwind in Wisconsin. We could share some stuff regarding that, but the governor is really come out in 2024 in support of the care worker in the state of Wisconsin. And they're putting a lot of funds towards that, which is going to be very beneficial for us as operators and you as owners. And then, you know, legally, obviously, we do a ton of stuff with insurance and make sure that all of that is what it should be. But just so you are aware, we also have multiple operating entities already at this phase of the game because we want to make sure that we always have the ability to operate. So we're not warehousing everything under one roof. Should there ever need to be a moment in time that we go get under a different roof, we can do that. So those are things that we've thought through, risks that we've sought to actively mitigate.
That's good. Also, I think it's really cool that you're involving Tracy, who was with Serenity Villa, the owner of Serenity Villa that we acquired last year, is a phenomenal operator. She started that assisted living facility, and she's now come on board with Arrows and is helping to run this part of their business. She does such a good job of creating culture and putting processes into place. And so she's getting to work at a higher level with multiple facilities, Sage Meadow being one of them. And I mean, Tracy is just awesome. Such a great person, staff member to bring on board that's got so much experience that you guys are now able to lean off of as well.
Yeah. Yeah. Tracy is a ball of fire, and, you know, you cross paths with people in life as you do business, and you can pretty quickly identify the ones that you need to figure out how to make, you know, part of your world. And I picked up on that the first time I met Tracy. And, you know, just I'm a storyteller more than anything else. Tracy's got a daughter. Her daughter's name is Brooklyn. The first time I met Tracy in Brooklyn, I'm very excited about Brooklyn. You know, it's one of those things that you kind of see over and over again. The apple oftentimes doesn't fall that far from the tree, and certainly not, you know, carte blanche, but Brooklyn is awesome. Brooklyn has been fully embedded into the business, and she's on fire. I think Tracy will just be on fire. You just got to keep fanning that flame. So they're doing a lot with us. They're super excited about this opportunity. They've been on site. They're ready to rock and roll. Our team's ready to onboard these two facilities and, you know, take them to the next level.
Awesome. I love it. Love it. So let's head on to the next slide. This is just a quick look at the investment highlights. Again, it's already cash flowing day one, which is fantastic. There's been some recent renovations, over $1 million, which is cool. There are some opportunities for adding value. The property's in really great shape. There's not a lot of deferred maintenance, but there's still opportunity with increasing the ratio of private pay residents. And what is the exact percentage right now with private pay versus public pay?
I mean, the right now answer to that is I think we're probably around 30% private, 70% public. So if we can work on inverting that, that would make a huge difference. I will say as well, maybe right here, that in simplicity, the current operator has their public pay residents set at a rate that is much lower than we have negotiated across the state of Wisconsin with our MCO relationships, so our public pay representatives. So, you know, shortly after we close, we're going to renegotiate the rates for these facilities, and that simple lever that we can pull is going to create a meaningful amount of new revenue. So as we look at this, that level of public pay residents isn't necessarily a bad thing if we just do some rebalancing. And you know, we're excited about that because that's something that's very easy for us to execute shortly after closing. It's having conversations with our MCO relationships and getting all of our contracts updated, and then all the revenue changes.
Yeah, that's huge, huge. And I mean, the property is 92% occupied. I mean, that's strong occupancy going in. Again, not a ton that it's not a huge value add in the sense that to go out and gut rooms and, you know, move residents out. There's so much already here.
None of that. I think today they're 95% occupied. I think we've underwritten sort of like a baseline at 90 because we've been consistently able to exceed 90. We had a facility at 100% here not that long ago that unfortunately had a resident pass away. So we dropped off the 100 mark, but we were totally full. So that's honestly, obviously, as a fiduciary and as a manager, that's our goal, right? Fill the entire place. And if we can stay above 90%, then again, it's just another way that we're going to outperform the baseline that we've set as at 90% occupancy. But currently, under the current operator, who's again a third party and not really aligned with the investment, they're at 95%.
Yeah, that's strong. And I would probably the reason you ever see residents leave is it mostly because of passing away? I mean, it's probably rare that you have people move out that are just unhappy or, have issues.
Yeah. So like there's some nuance here. If you look at, and maybe it's not that nuanced, but I could get into the nuance, right? If you're a 28-year-old tenant at your multifamily property wants to go to another place when their lease is up, they're 100% going to do that, right? If your 78-year-old resident or 88-year-old resident picks your facility, unless they medically need to leave, they are really not going to leave. And the nuance would be if like any of you have experience with older folks, they're very, very at this point in their life and at this point in their journey, they're set in their ways. And oftentimes that generation is just very stubborn. So, if you've lived in a community, maybe you worked in town, these are the folks that built the small towns and the small cities of America. And they built them and they lived there and they stay there. And if you've had a friend or two or more that's passed away in a facility and that place is a safe place and you decide you're going to go there, you're going to be there until you pass, unless medically you need to go to a higher level of acuity. But, this facility here, Sage Meadows, we're going to be basically residential apartments all the way to memory care. So we're going to be able to kind of cover the spectrum of acuity for our residents. And it's just not likely that they go anywhere else if we do what we're here to do.
It's amazing. And the range of pricing involved from your public pay that are, probably the lower end and needing just the basic care up to all the way to memory care. What's the range on the pricing per bed for that?
It varies. The RCAC, so the residential apartment community, is going to be in the mid fours, call it 4,500. Right now, we're seeing private pay rates in the area in excess of 6,500. So I think this facility, their private pay average right now is somewhere around 5,900. So, just that right there, again, if you're bringing on a new resident and they're coming in on average at 5,900 and you're working to move that average to kind of market, which would be 6,500, you can understand what that means across, the entirety of this property. So that's where we have an unfair advantage because, we have a facility 20 minutes away and we know our pricing structure there, and we can bring that same pricing structure to these facilities and be successful shortly after closing. And a lot of the reputation, we believe, is going to start to transfer, and that's how we're finding new opportunities, and that's how we're proving out some of these theses that we've had about operating a really phenomenal team and building that reputation. And pulling Tracy in from the previous acquisition was just a hack to be able to accelerate the reputation, because she'd been an operator in the state of Wisconsin for 13 years and she's loved by everyone. And I've got a story about a follow-on acquisition that's coming up that, is incredible. And a lot of it's just because we have that shared alignment to see these residents taken care of. That's her heartbeat. And for us to see you taken care of as an investor, to not be investing in something that may or may not deliver a return, but we're going to do everything that we can on the operational side to ensure that that operation drives the returns.
Yeah, and the team behind this, I mean, we have quarterly meetings on Serenity. We'll do the same with Sage Meadow. And Mark is just doing a fantastic job. You can see on the screen, Mark Warner's the portfolio performance director. He is, man, in the details, and he has his pulse on everything that's happening at the property.
You have like, I have this, I literally pulled, obviously I didn't know you were going to say this. But I pulled this up last night because I knew we were going to have this call, but it's something that speaks to what you just said very specifically. So this is verbatim. This is a quote. Internal chat. So an internal chat between partners, right? That's the context. That's the frame we're looking through here. In quotes, I had my quarterly review with Connect team and they went through our use of the tool. They said we have one of the highest levels of engagement they have ever seen at any of their user organizations. My point is, if the behavior and the incentives are right and they're aligned, the tool will work. So we were having a conversation about like, how do you tool these things? And that software and all the ways that we've kind of built the incentives within it. We have like a coin system where people can earn coins and then they can redeem them for gift cards and swag and all this other stuff. Like we've built these things out and the software company is watching us use it. And we have one of the highest levels of engagement that they've ever seen. So that is Mark. That is Mark. And that's a testament to what we're actually trying to do here and legitimately building a team, not just building another, facade of one or shell of a team, but truly building it.
Absolutely. I love that. Thank you for sharing that. And it's obvious. I mean, when you get on these calls and you hear him talk and share data, and that comes out with the investor reports as well. We send those out quarterly. You're going to get so much information. You're going to know what's happening here at the facility. It's not just something that's operating. It's truly striving and doing phenomenal. I just have been so impressed. So thank you for sharing that. We're not going to dive into all of these slides. I'm going to provide this slide deck to you all. If you haven't already taken a look at it, you can read through this. It just gives you a little bit more insight on what assisted living is, the market analysis for it. It's on the rise. I mean, you can see some of these statistics that there's just a huge growth of this demographic that's coming into assisted living facilities and that will need assisted living facilities in the future. You can see the very bottom, it says by 2060, that number is going to grow to nearly 95 million. I mean, there is just such a huge influx coming down the pipeline. And I think also, and this is not a good thing in a way, people don't take care of themselves as well as they should. We live in a very stressed out society that lives on fast food and just constant go, and there's disease and things that we encounter in our lives. And that unfortunately puts, the older demographic in a place where they really need extra care in the later years. And so I say that because I think that there is just a growing demand and we're able to, again, provide a solution. And I think there's always going to be a need for it. And so DJ, I don't know if you want to hit on that anymore, but you guys can definitely take a look at these slides where we provide some of the statistics.
Yeah, I mean, the statistics honestly do all the work for us here. We don't have to carry a lot of water. Our thesis, again, maybe to be a little more subtle, is that the secondary and tertiary markets of the senior care industry are where it's at. If you think about the fabric of who these people are and how their lives kind of transpired through time and what they accomplished and where they live, if you actually look at where they live, that's where they want to die. Again, back to 10 minutes ago, they've been there their whole life. This is true a lot in Wisconsin. So I wouldn't apply this frame or this logic to, maybe a Sunbelt market, right? Where people have come and gone more, or they maybe didn't grow up in that area, but they moved to that area at a later date. Like I would be representative of that in my own example. But these folks, if you went and sampled, and this is maybe something we should do, maybe we park this car for a minute and make a note to do this, but I would love to to actually go survey the folks at our facilities and just ask them, where they were born and raised, to see how many of them were born and raised in Wisconsin. You know what I mean? Because I can imagine that number is very high because they've lived there. They are the fabric of the land and they want to die there. And so if you think about it through that lens, you want your facilities to be where these people are. I don't necessarily want to be where like the new growth is going, because maybe that's not where these people are going. So that really just puts you in a position where you have to think about balancing what you're doing and serving the community, as opposed to trying to chase a market that's going to be growing. I mean, really, in the state of Wisconsin, we're not going to be seeing a ton of that growth, but we are going to be seeing more and more and more residents at these facilities. So our position is that the secondary markets are going to be really ready for us to show up and serve and create an outsized return, because the demand is going to be there. And we have a pretty long window of demand. I mean, these numbers are going out to 2060. Okay. We're in 2024, y'all. Like, we have a minute to get to 2060. So I think as long as we aren't part of an overbuilding boom that comes in the future, I think these investments are really risk adjusted and well positioned. If you look at the nuance of maybe getting into a smaller market as opposed to feeling good about being in a big market.
That's good. Thank you. And this is a look at just a couple of pictures of the property. As mentioned, there's 2 different locations. They each have 40 units. One of them has 44 beds, and they're newer. I mean, they're 1997, 2001 built for the first, 2002 for the second. So they're not super vintage product, but they're in good shape. Very little deferred maintenance, which is awesome. And one has one site with a 2-story building, one in a 2-story building. The other one has a 1-story building. So if you're ever in the area and want to take a look, we'd love to show you. Immediate growth opportunity. This is just putting some of the software, the different programs in place that have already been put in place over at Serenity, and we're seeing big impact. We're able to do that here at this property as well. So yeah, if you want to talk to that, DJ, as well.
Sure. I think there's a couple things here that are maybe interesting to highlight. As a business owner, you kind of get in the groove of running your business and you take your eye off of these expenses that pile up over here and the ways that you're kind of getting the business to work and work well. So once you get it working well, you kind of shut off that problem solving part of your brain. I find this to be true in these environments. If you're a third party manager and you have a pretty good sized portfolio that you're managing, you're probably not keeping an eye on this stuff that well. That was our experience right out of the gate. If you're maybe a smaller owner operator or something along these lines, then you've solved those problems and you're sitting in some version of cruise control as the business owner. So what that then creates on our side is opportunity to show up and do simple things that really not only improve the operations of the facility, but then act as a true cost cutting measure. So if you look at like line 2 right there, and 3, they kind of work together, just swapping out the way that we do telephones, or, in this case, we went to digital TV antennas and slashed $30,000 just by going to digital TV antennas, or Connect Team at the top. The last property that we acquired, Serenity, it's been mentioned by Rebecca. They were utilizing Paychex as a payroll provider, and they were utilizing their time clock functionality, which, I mean, that's a logical decision to make, right? Well, we have this software that we have fully customized and built out, and we brought that functionality into our software. We're already paying for the software. We brought that functionality into the software and eliminated that $14,000 bill that came with like time clocks. So you can solve these problems when you come in with that outside eye that the business currently is not really looking to solve. And it's genuinely pretty easy to do. And we benefit from those measures. And we've solved a lot of these problems now. So we can go in and say, okay, here's what we're going to do. And we can do it pretty expeditiously, much like, renegotiating the MCO contracts for our residents and bringing the new baseline up to $150 as opposed to $122. So these are the things that we look to do because of the experience that we have.
And it's quicker because you've already been through them. That's not a huge um, time spent. So this is a look at the financial performance and projections. DJ, I don't know if one thing I appreciate about Arrows too, is just they're very conservative in nature. They like to underpromise and overdeliver. And so if you'd like to hit on this at all in terms of what you guys did on the underwriting front, that'd be great.
Sure. I mean, that's true. That's definitely, I'm not going to claim that to be my gift, but we'll just take a look at that maybe top line number. That's an easy place for the eye to wander. And we're really making a marginal adjustment to revenue. Some people would see that as a huge adjustment to revenue, but even some of the things I've said in this call or in this conversation, if you take the 70% of your residents and you move their contract price from 122 to 152, that's going to have an impact. And some of those you're actually doing a reassessment. So as you kind of take over operations, you do a reassessment. Not only are you just renegotiating your base rates, but you're assessing everyone. And a lot of these folks are going to have a different assessment than the current manager would have them assess for. So again, it's a very similar dynamic that plays out where the resident has been brought into the facility, they've been assessed, and they're paying this rate. And if they're there and the money's being collected and the manager's managing, it kind of runs. Well, we come in and we reassess, and a good portion of these folks are going to be reassessed at not only a new base rate, but we're also going to reassess their acuity, which is going to up their base rate. So you might have, and I could probably have pulled out some examples of this, but we've seen rates go from like 80 to 150. So, like that'll happen in this case as well, where we're going to have people that are at $100 because again, that's an average. We'll have people that are at $100 and we'll move them up to $175. So if you start thinking through that lens, you can see that top line number where we're making, a few $100,000 adjustment in year one as very achievable. And then factoring new private pay rates. And so one of the things we look at are I anchor on just a few simple things because I tend to try to get to like the foundational parts of a thing. What's your average rate? Because really, if you can just drive average rate and get top line up, then that enables the entirety of the rest of the thing. It's a business. So, that allows Mark and the team to start working on the expenses. We have a great team that is really great at driving that top line up. And likewise, we've over budgeted down on the expense side as well. You could take a look at right now, they're spending 6,600 on marketing. We jumped to 60K. That won't need to actually, like, that amount of money will not be expended, but it's there because, it's a fine place to put a placeholder for maybe we do need a place for mom to kind of get jump started, but likely not. If in case we do, there's some money there. Obviously, we're going to be kind of doing the whole takeover of a new facility. So you have all the new stuff that comes in from a marketing perspective, but that number is a very, very safe number, very safe number. And you could kind of look down through here and see that nothing else is really going to the downside. We're not trying to skin anything in the beginning, right? So we believe these truly are reasonable numbers and approachable numbers and numbers that we can achieve.
Good, thank you. And then the debt assumptions, I think this is really important to hit on. A lot of you have probably had some concern over the last couple of years with where the debt market has gone. Interest rates have risen, and there's been a lot of impact to investors and deals, especially when there was bridge debt put on a property. So I talked to DJ about this earlier, just sharing a little bit about why we have to go with the bridge debt initially and then moving into the HUD loan. If you want to just speak to how that works, why we use a HUD loan, I think that'd be really helpful for our investors.
Yeah. Some of this, I obviously, again, just kind of revert back to putting it into simplicity. We have a relationship with a lender. I can actually go meet with him right now if needed. And so the lender is servicing this bridge loan. They actually service it with an in-house product. So the way we acquired the last acquisition is the same exact way we're acquiring this acquisition. So we've built, again, we've kind of built the rails that this little train we have here can run on. And we've gone back to that same lender, same team, same legal, same everything, and we're just running it again. So we're doing a bridge to HUD. The reason why we do the bridge is because we can actually close a transaction on the timeline that the transaction needs to close. And in that process, we're doing all the HUD paperwork to prepare for that HUD loan. When you go into the HUD queue, you can kind of sit there for a bit, right? This is a government-backed loan, so I don't need to say much more. Simply put, the major benefit of getting this loan is the amortization. So we're putting in place an assumable 35-year loan. We don't have that right now from the current operator. This was a locally originated loan when they purchased. So, we're putting something in place that's going to create a better exit strategy for us in the future, because that the person that's going to step in and could acquire this loan, and they still have a long way to go on this loan. So that's the main reason why we put ourselves in a position to strive for this setup, where we use the bridge and the bridge team to facilitate the HUD loan, and we move right into the HUD loan pretty quickly after closing. They want to see a little bit of duration of ownership, and they want to see some financials and those types of things. So we'll run it out for a little bit to achieve that and move right into the HUD process. And then we sit in the HUD process for a little while. It's kind of like a hurry up and wait type thing. But we'll get there, and we'll get that loan. And I'd imagine when we actually originate, the rate, based on the current environment, the rate's probably going to be a bit lower. So we'll see where that shakes out when the time comes.
Absolutely. That's really good. In terms of acquisition fee and management fee, can you speak to that just a little bit in terms of what that percentage is every year?
Yeah, we basically run a 5% fee, somewhat across the board. We run a 5% fee here at the acquisition to do all of this, and then a 5% fee to manage the asset in an ongoing manner. Very, very hands-on, as you can tell. And then we run a 5% fee at the property management level, which is, we found to kind of be right at market, sometimes under market for this level of management that's required, because it is not as easy as just bringing a tenant in and putting them in their new unit and walking away and waiting for the next maintenance call. This is running a full-on 24/7 business where people's lives are in your hands. So we run basically a 5, 5, and 5 from a fee perspective.
Good. All right. This is just to look at the sample investor returns. I'll let you guys review this on your own time. I do want to hit on that there's a 7% preferred return. So you as the investor are getting the first 7% of distributable cash flow annually before any of the GPs get paid. So after we've hit that preferred return is when the split happens, 70% to the investor, 30% to the GPs. And again, it's a 5-year hold. And these are just projections. I want to be very clear. They're not guaranteed, but as we execute the business plan, hopefully we'll hit this and even more so on that front. And DJ, do you mind just mentioning very briefly the depreciation, that we will be doing a cost segregation study? But at this point, it's hard to know exactly how much we'll get, and that those laws are changing, that depreciation schedule has gone down, and we'll see what the next administration does. And so just know that you will get to share in some of the depreciation, but we can't give you the exact amount at this point until we do the study and also see what the administration does in the future.
Yeah, 100%. We'll likely within a month of closing, we'll initiate the cost seg, and then we'll wait for the results of the cost seg, and we'll pass every benefit on that we can to you as the investor. So that's basically the promise we can make at this point. We will do everything we can to make this a successful investment for you.
And one other thing I've had come up with a couple investors is they're curious about a 1031 exchange for For those that might be interested, we are not able to do that on this deal, but we may be able to on future deals. If that is something that you're considering, please reach out and let's talk about it and what you're looking for, how much money you're looking to deploy. It would have to be a larger check in the future. So definitely keep us in the loop if that's something you'd like to do. And then lastly, this is our investing period. We are in the midst of reviewing the materials, signing the documents, funding your investment. So if you are interested in moving forward with this, please reach out as soon as possible. We are close to closing, hopefully next week. And so please do reach out. We're happy to help and answer questions. Is there anything else you want to add, DJ? I'm actually going to turn off the slideshow because we're right at the end. Anything you want to
I
share?
don't have a lot to add. We did bump closing back just a little bit because of some lender requests, which are fairly normal. This happens consistently in deals of this magnitude. So we do have a little bit more runway, not much. So I would say, if you are interested to ask any question that you need, get any answer that you need to become comfortable with this investment, and then be prepared to execute those docs and fund pretty quickly. I would say within the next week to 2 weeks. And we'd love to have you on board for this opportunity. And we look forward to serving you in any way that we can. Thank you so much, Rebecca, for creating this opportunity to, again, work together.
Yes, absolutely. Thank you for your time, DJ. Thank you all for listening today and checking out this opportunity. I hope we'll have the chance to work with you in the future, whether it be this one or a future deal. So thanks again, and we'll be in touch.